Let me give you a number. $39 trillion. If you spent $1 million every single day since the birth of Jesus Christ, you still would not reach $1 trillion. That is not even 3% of what America owes right now. It works out to roughly $114,000 for every single American, man, woman, child, every one of them. You have been told this is fine. You have been told it is backed by the full faith and credit of the United States government. You've been told to trust the process. Here is what you have not been told. The only reason that number has not already destroyed the American economy is because of a system most Americans have never heard of, never voted on, and never been asked about. A system built in secret in 1974 that forced the entire world to keep buying dollars just to keep their lights on. That system is now cracking. And when it breaks, it does not break for someone else. It breaks for you, in your mortgage payment, in your grocery bill, in your retirement account, in the job market your kids are walking into. This is how it happened. And this is what comes next. In 1944, the United States gathered 44 countries in Bretton Woods, New Hampshire, and made them an offer they could not refuse. America had the factories, most of the gold, and a military that could politely discourage disagreement. The deal was simple. Every country would peg their currency to the dollar. The dollar would be pegged to gold at $35 an ounce. A dollar was not just paper, it was a claim on something real. For about 20 years, it worked. Then America started making expensive decisions. Vietnam, the Great Society, a defense budget that would make a Las Vegas whale blush. By the late 1960s, the U.S. was running deficits and printing dollars faster than it had gold to back them. The French noticed. They did the math, looked at America's gold reserves, and decided the numbers did not add up. So they loaded dollars onto planes and came back with gold. Over 3 years, France repatriated more than 3,000 tons of gold. Other countries followed. America's gold reserves, once 80% of the world's supply, started draining. By 1971, the jig was up. Richard Nixon went on television and closed the gold window. Dollars were no longer convertible to gold. No warning, no vote. The Americans called it the Nixon shock. The French called it several things that do not translate politely. The global financial system, previously tied to gold, was now built on a vague sense of trust that America would behave responsibly. Given the preceding decade, that was quite a lot to ask. Then Henry Kissinger stepped in. The dollar had just lost its gold backing. The economy was wobbling. America needed a new reason for the world to want its currency. Kissinger's solution was almost absurd in its simplicity. If you cannot back the dollar with gold, back it with something every country needs every single day: oil. Behind closed doors, Kissinger struck a deal with Saudi Arabia. The Saudis would sell their oil exclusively in U.S. dollars, which meant every country on Earth that needed oil would first need dollars to buy it. In exchange, America guaranteed Saudi Arabia's security. The Saudis got the most powerful bodyguard in history. America got its monetary system back. Within a year, every major oil producer followed. No vote, no summit. Saudi Arabia moved and everyone else fell in line. The dollar was now backed by oil, the single largest traded commodity in human history, worth approximately $2.5 trillion per year, more than gold, copper, aluminum, nickel, zinc, lead, tin, cobalt, and lithium combined. And here is why that matters to your life right now. When every country needs dollars to buy oil, those countries accumulate dollars. When they accumulate dollars, they invest them, mostly in U.S. Treasury bonds. which means foreign governments have been financing Washington's deficit spending for 50 years. America built highways, funded wars, expanded its military, and ran trillion-dollar deficits, while the rest of the world helped foot the bill. It was like installing a toll booth on the global economy and making every country pass through it just to turn on the lights. That toll booth is what has kept American inflation from being far worse than it already is. The reason your groceries are not even more expensive than they already are is because the central banks of Tokyo, Frankfurt, New Delhi, and Seoul are absorbing trillions of American dollars every year just to keep their economies running. And now, they are quietly looking for the exit.
China imports nearly 2 million barrels of oil per day from Saudi Arabia alone. For decades, it paid for all of it in dollars. But in 2021, a project launched quietly out of Basel, Switzerland, called mBridge, the Multiple Central Bank Digital Currency Bridge. The name is forgettable. The idea is not. mBridge lets countries move money directly between each other using digital currencies issued by their own central banks. No Western intermediaries, no SWIFT, no U.S. oversight. When Russia invaded Ukraine in 2022, the G7 froze approximately $300 billion in Russian reserves and kicked Russian banks off SWIFT. Every non-Western central bank on Earth watched that happen and asked the same uncomfortable question. What happens if we're next? China did not write a strongly worded letter. It built its own exit. By late 2025, mBridge had processed over 4,000 transactions worth $55 billion. Still tiny compared to SWIFT, but it works, and it was not designed to ask America's permission. Meanwhile, the dollar's share of global foreign exchange reserves has dropped from around 85% in the 1970s to roughly 58% today, the lowest point in 2 decades. India is buying Russian oil in rupees. Brazil and China have ditched the dollar in bilateral trade. BRICS now represents nearly 36% of global GDP and 44% of global oil production. Saudi Arabia is conducting transactions on mBridge while simultaneously declining to formally join BRICS. Exactly the strategic ambiguity of a country keeping its options open. None of these systems replaced the dollar overnight, but the dollar did not take over the world overnight either. Here is where all of this lands in your actual life. The U.S. government currently pays over $1 trillion a year in interest on its debt, more than the entire defense and education budgets combined. That number stays manageable only because foreign governments keep buying U.S. Treasury bonds, which keeps bond prices up and yields down. And mortgage rates track Treasury yields almost exactly. When rates moved from 2.65% to 7.79% between 2021 and 2023, the monthly payment on a $400,000 loan jumped by almost $1,300. Now imagine that instead of the Federal Reserve raising rates deliberately, the driver is simply fewer countries needing to buy dollars for oil. Fewer dollars needed means fewer treasuries purchased. Bond prices fall, yields rise, mortgage rates follow. And the Fed cannot stop it by cutting the federal funds rate. It cannot force central banks to keep absorbing American debt. Every reserve currency in history has eventually lost that status. Every single one. The Roman denarius, the Dutch guilder, the British pound sterling. When Britain lost reserve currency status, it did not happen in a single catastrophic moment. It happened through decades of inflation, emergency bailouts, and a standard of living that steadily declined relative to the rest of the developed world. The pound simply became less and less relevant. British citizens absorbed the cost in ways that never quite showed up on a single front page. That is the template for the dollar. Not a single crash, a slow bleed. And we are already inside it. So what do you actually do with this information? Because awareness without action is just anxiety with better vocabulary. First,
Understand that this is a long-term shift, not a tomorrow event. The dollar is not collapsing next month, but the direction is clear and has been clear for 15 years. The decisions you make today about how you hold your wealth, where you keep your savings, and how much debt you carry are decisions being made inside a system that is under structural pressure. Second, reduce your exposure to dollar-denominated debt where you can. The single most dangerous position in a de-dollarizing world is carrying large amounts of variable rate debt. Fixed rate debt is far less exposed to the interest rate volatility that comes when foreign demand for treasuries weakens.
Third, think about diversification in ways that go beyond the stock market. Real assets, property, commodities, inflation-protected investments behave differently when currency systems shift than paper assets do. This is not financial advice. It is history. Every time a reserve currency transitioned, real assets held their value better than paper claims on governments. Fourth, pay attention. Not to the daily noise of markets, to the structural signals. Watch what Saudi Arabia does with Mbridge. Watch what the BRICS payment system developments look like in late 2026. Watch how many countries reduce their treasury holdings at the next quarterly report. These are the readings on the instruments that most people are not watching.
The American dream was built on a foundation that the rest of the world agreed to support. That agreement is not being torn up overnight. It is being quietly renegotiated, one yuan-denominated transaction at a time, one Mbridge payment at a time, one treasury bond not purchased at a time. By the time it shows up as a front-page headline, the adjustment will already be well underway. The question is not whether you saw it coming. The question is whether you did anything while you still had time.